Most insurance agents don't have an income problem, they have a money allocation problem. Everything flows into one operating account. You don't know what to pay in taxes, you don't know what to reinvest back into the business, and you don't know what to pay yourself. Without a clear allocation system, oftentimes there's confusion. So I want to get into one thing I learned from reading the book, Profit First, from Mike McCallowitz. I can't take credit for this. This is his system. So it's an allocation system. It's based off, as an insurance agent, you can break this down into four different parts: owner's comp, taxes, profit, and OpEx. If you're if you pay payroll, you can add a payroll account, you can include that in OpEx. There's a lot of different ways you can customize this. So here we're going to base this off 0 to 250K in revenue. So current, sometimes he calls this caps, current allocation percentages, and taps. These are your target allocation percentages. So the reason that these are segmented like this is because you want to get to the target, right? So if currently your owner's comp, let's say this is 40% target, and your OpEx would then just be 40% OpEx. That's what you spend on the business. Now, the taxes are 15% of gross revenue, right? Now, that might seem like a lower percentage for taxes, but remember, you have your gross revenue, you have your expenses, you're paying taxes after expenses. So this 15% will actually be a higher percentage of the gross that's left over after expenses. So this is a safe number. So if you go back and you look at your books, your P&L, and you can go back and look, okay, what did I pay myself? What did I have left over for taxes? What was profit? What was OpEx? Oftentimes people confuse owner's comp and profit. So the profit is, owner's comp is basically what you need to live, right? So you set this allocation. The profit is like, okay, the business did well. I'm going to take a profit distribution. I could use that profit distribution to go on vacation or whatever, any kind of personal goal that you have. So if you see that this is 50%, and let's say you didn't set aside anything for taxes, you didn't even know what this was, and the other 50% was OpEx. So now you have to get to the target allocation percentages. So one thing that Mr. McCallum stresses is you're not going to get there all at once, right? So you'll have your current allocation percentages. You'll set new current allocation percentages, new caps, at something that's not all the way to the target, but maybe it's 45, right? Maybe your taxes, maybe you'll start setting aside 5% because you got to cut, maybe you got to cut expenses, or maybe you got to reduce what you're paying yourself because you don't have anything left over for taxes at the end of the year. So you can set your current allocation percentages at 45. Maybe this becomes 5. Maybe this becomes 5, and that becomes 45. And over time, you'll get to your target because you'll keep inching up the percentages. One important thing to note, these are separate bank accounts, right? So you have an income account. Okay, with your income account, so you here in this scenario, you have 5 bank accounts. So everything flows into your income account, and from your income account, you make these allocations. So 40% is going to go in the owner's comp, 15% is going to go in the taxes, 5% to profit, 40% to OpEx, right? That's how I'm going to run the business. So every time you get a deposit, you could do it weekly. You could do it every 2 weeks. You could do it every month. Whatever works best for you. I do it weekly. I pick one day a week, make the allocations, especially if you're insurance, you could be getting deposits multiple times a day, every day of the week. So doing it weekly works for me. So now when you're at this revenue band up here, these allocations are going to change, right? So maybe you don't need what you need to live, right? It's a smaller percentage of this. So let's say this is 35%. Unfortunately, the more money you make, the more money the IRS wants. So that's going to stay the same at 15%. Let's say I raise my profit allocation. This is, let's see, I'm actually going to do this a little bit differently. Let's drop this to 25. Again, my taxes is going to stay the same. My OpEx is going to go up because I'm getting to an individual producer revenue breakpoint, right? So when I'm at 250 to 500, and I'm going to raise my OpEx to 50%, because guess what? I'm probably going to need to hire somebody. I'm probably going to need to hire some support at this breakpoint. Okay. Now, when we get up to the next threshold, 500 to a million, again, this can come down because we don't need as high of a percentage to get to the same owner's compensation. Maybe my compensation is going up slightly at every stage as well. Let's see, I'm going to take this down. And I'm going to make this 15. Okay, my taxes, again, I have to pay the IRS the same amount. My profit, I'm actually going to keep that at 15. So I have 45, and my OpEx is going to be 55. So you can see one common theme here is as your revenue grows, your OpEx is growing, you're putting more back into the business, right? You're making more money, 15%, depending on what this ends up at, is likely going to be higher than what 25% was. You're making sure you have the taxes set aside, and the profit account, you can distribute that quarterly to yourself. So this is where we really see the increase in the personal income. If you're an individual insurance agent, now when you get to this higher band, now maybe your owner's comp is up 5%, right? Again, your taxes are going to stay the same. You're at 20. Your OpEx is going to go to 60. Okay. And then your profit allocation here, I'm going to keep this at 10. And then I'm going to keep this at 15. Okay. So OpEx goes up for every revenue put in, owner's comp comes down, profit goes up. This is where you can say your raises, your taxes stay the same. So one mistake that often occurs when people do this is they try and jump from what your current allocations are to your targets all in one leap. And that is going to be a big mistake, right? So especially if you're trying to cut expenses because you didn't save money for taxes, maybe you go to 49% and you do that for 2 months. You try and get there. You cut some subscriptions that you haven't looked at. You look at your P&L, you see some subscription, you're like, I don't use that anymore. You're cutting that back. You're inching down this percentage, right? And then you're inching these up, and you're doing it over time. So you can set your caps and your targets. I usually do it quarterly. So I'll look back at the last quarter, then I'll look back at the P&L for the last 12 months. I'll see if I can identify a recurring theme there, and then I'll keep inching up. The important thing to remember is sometimes people say, oh, well, I'll just do this on my books, but I'll keep everything in one account. I don't know. That doesn't work for me personally. I haven't really seen it work for anybody else. It doesn't cost any money to set up these separate bank accounts. Another thing that'll come up is people will say, oh, especially if you're in this, you get up to this section, you have this money sitting in these non-interest bearing accounts. One thing in the book that you'll notice with the Profit First system is you can have these hold accounts, right? So you're putting money into taxes because you want the business to pay your taxes. You don't have to pay your taxes personally, right? So I tie this to a money market account. That's a tax hold account. Again, I'm not an accountant, but I have my personal business set up as an S Corp. So as an S Corp, you can do one withholding at the end of the year. You don't have to pay estimated taxes, right? So I take the money that is set aside for estimated taxes. I put that in a money market account. I buy treasury bonds. And at the end of the year, when there's one last payroll cycle left to pay myself, I do one large federal withholding and a state withholding. So then I transfer the money from the money market tax hold account back to my tax account. From the tax account, I move it over to wherever my payroll's coming out. Let's say it's the OpEx. I'll move it over to the OpEx account. I'll do one large withholding, right? So as long as my withholding is at, I believe the safe harbor is 105% of what my tax bill was last year. There's no penalties doing it that way. In this past year, you'll earn 4 to 5.5% off the treasury bonds. So that's kind of how I do it on the tax hole. If you see that, oh, okay, my profit account, I'm not taking a profit distribution until the quarter's over, you can tie your profit account to a money market account as well. Um, with this interest environment the past few years, I mean, to me, it makes sense. A lot of times people say, well, don't worry about the couple of points of interest. Once you get the first part down, again, don't bite the whole thing off all at once. Once you get the first part down, you set up 5 accounts, and then you get pretty good at your target allocation, getting to your target allocation percentages. Then I would worry about the whole hold accounts, right? So do it in steps, brick by brick. You can set up the hold accounts. Once you get to the target allocation percentages and you've held it for a quarter, then I would set up the hold accounts. Then you can start moving money over to the hold accounts to earn some interest off of the money. Especially you have that extra incentive being set up as an S corp to do one large federal withholding at the end of the tax year. And again, I'm an accountant. Okay. We have another video here for insurance agents as well. You can check that out. Thanks for joining us.